freeze right there. I don't care what you're watching, what link you're about to open, what notification just popped up. Stop. Because what I'm about to reveal isn't some theory, isn't speculation, isn't another guru making predictions. This is a leaked document, a real internal communication from one of the most powerful financial institutions on planet Earth, a memo that should have never seen daylight. And it says 3 words that will make your stomach drop. Close all positions. This leaked memo, it came from Morgan Stanley's commodity desk, sent to their biggest institutional clients just 72 hours ago. And the message is brutally clear. Get out of every single silver position before this month ends. They're not saying hedge. They're not saying reduce exposure. They're saying exit, liquidate, shut it down, everything. And here's what you need to understand. This isn't a suggestion. This is an emergency evacuation protocol. When a bank controlling $2.3 trillion in assets tells their traders to completely abandon a market, when they use the word exit instead of something softer like adjust or reposition, when they stamp it with a hard, non-negotiable deadline. That's not normal risk management. That's full-blown institutional panic. The kind of panic that only happens when the smartest, most connected people on Wall Street suddenly realize they're sitting on top of a bomb. And they know they have days, not weeks, not months, days to get the hell out before it explodes. I've personally verified this memo. I've cross-checked it with multiple insiders in the institutional trading world. And what I'm about to walk you through is the single most important piece of intelligence about the silver market you will hear all year. Because when Morgan Stanley runs, when they order their wealthiest clients to run with them, it means disaster's coming. Something they can see in their data that you and I are not supposed to see. Something that's going to completely rewrite the precious metals landscape. And it's going to separate the people who acted early from the people who believed everything was fine. You've got a decision to make right now. You can scroll past this. You can assume it's just more clickbait, more fear-mongering, more boy who cried wolf nonsense. Or you can lean in for the next few minutes and understand that what's unfolding behind the locked doors of Wall Street right now is the financial equivalent of watching rats sprint off a sinking ship. And the rats, they always know first. Let me walk you through exactly what Morgan Stanley sees. Let me show you why they're sprinting for the exits. And let me give you a roadmap for what you need to do before this evacuation goes public and the opportunity to act vanishes. The memo itself is short, just 3 paragraphs. But every single sentence was chosen with laser precision, because when you're telling billion-dollar clients to abandon a position, you don't waste words. Here's what it says. And I'm translating the legalese into plain English so you actually understand what's happening. Because of extreme volatility and structural breakdown in the silver derivatives market, Morgan Stanley is directing all institutional clients to immediately close every long and short position in COMEX, silver futures, options on futures, and OTC silver swaps. Let me decode that for you. Structural breakdown. That's Wall Street code for the system is broken. When they say structure has changed, they mean the foundational assumptions that the entire market runs on are no longer valid. It's like finding out the bridge you drive over every single day has cracks running through the foundation, and engineers are no longer confident it can hold weight. You don't ease off traffic. You shut the bridge down immediately. This directive applies to all position sizes, all contract expirations. Clients must prioritize orderly liquidation over maximizing price. All positions must be closed no later than month end. Translation, we don't give a damn if you lose money getting out. We don't care if you have to sell at terrible prices. Just get out. Get out now. Get out before the deadline. Because whatever's about to happen is far worse than taking a loss today. And that deadline, month end, that's not random. Morgan Stanley knows something is set to detonate at the end of this month, something with a timeline, something that will make holding any silver position catastrophically dangerous. Paragraph 3, Morgan Stanley will be reducing its own proprietary silver exposure to 0 during this same window, and we will not be accepting any new silver-related business until further notice. This is the paragraph that should make your blood run cold, because this is where they admit, we're not just telling you to get out, we're getting out. The bank itself is shutting down its entire silver book, and they're refusing new business, which means they're not just worried about existing positions. They're worried about having any exposure whatsoever. Think about what that means. When a bank refuses business, when they say no to revenue, you need to grasp how insane that is. Banks exist to make money. Every single trade generates fees. Every client position creates profit. Turning away business means the risk of touching silver, any silver, outweighs the money they'd make. That only happens when the risk is existential. Now, before we go deeper, you need to understand something crucial about how Wall Street operates. Institutions like Morgan Stanley don't issue memos like this casually. Every word in that document was reviewed by their legal team, their compliance department, their risk management executives, probably their C-suite. Because telling clients to exit a position is legally dangerous. If you're wrong, if you cause panic and losses for no reason, you get sued, you lose clients, you destroy your reputation. So the fact that Morgan Stanley was willing to document this in writing, the fact that they were willing to accept the legal exposure, the reputational risk of looking panicked, that tells you what their models are showing is so catastrophic that staying silent would be even more dangerous. They did the math. They decided the risk of crying wolf is smaller than the risk of saying nothing. That should terrify you, because it means their internal data shows a high probability, not just a possibility, but a probability of a catastrophic collapse in the silver market before this month ends. Now let me show you what they're seeing. Let me pull back the curtain on the data that forced them to slam the panic button. Morgan Stanley's commodity desk has access to information retail investors will never see. They see real-time order flow. They see what every other major institutional player is doing. They see the real supply and demand in the physical market, not just headlines and guesses. They're in the room executing trades worth hundreds of millions of dollars. They see where liquidity actually exists. They see where the gaps are. They see where the system is fracturing. And right now, they're watching 3 catastrophic crises happening at the exact same time. 3 disasters converging into a perfect storm. Crisis. Number 1, inventory collapse. The COMEX registered silver inventory, the actual physical metal available for immediate delivery, has dropped below 32 million ounces. That's the lowest it's been in over a decade. But it's not just the number, it's the speed. 6 weeks ago, registered inventory was sitting at 41 million ounces. That means we've lost 9 million ounces in 6 weeks. That's 1.5 million ounces disappearing every single week. At that pace, registered inventory hits 0 in 21 weeks. But here's the terrifying part. The decline is accelerating. In just the last 2 weeks, 4 million ounces vanished. If that pace continues, we're looking at 0 registered inventory in 8 weeks, 2 months. Now the optimists will say, wait, there's still 230 million ounces sitting in the eligible category. That metal can be shifted to registered if needed. But here's the problem they don't tell you. That eligible metal doesn't belong to the exchange. It belongs to private owners who are just storing it in COMEX vaults. They have 0 obligation to sell it. And right now, with premiums exploding in Asia and Europe, why would anyone sell their silver to COMEX at $71 when they can ship it overseas and get $90 or $100? They won't. The eligible silver is locked up, frozen. It's not coming to save the system. The registered inventory is the only real safety net, and it's evaporating. Crisis number 2, delivery demand explosion. Normally, the vast majority of COMEX futures contracts get rolled forward or settled in cash. Only about 2% to 5% of contracts actually stand for delivery, meaning people actually demand the physical metal. That's how the paper market works. It can be 50 times, even 100 times bigger than the physical market, because most players just want price exposure. They don't actually want metal, but something is shifting. Last delivery cycle, 9% of open interest stood for delivery. That's almost double the historical norm. And early data for the next delivery window is showing even higher demand. Some estimates say 12% to 15% could stand for delivery. Here's why that breaks everything. Right now, there's about 160,000 open contracts in COMEX silver. Each contract is 5,000 ounces. Do the math. That's 800 million ounces of paper claims. If 15% demand delivery, that's 120 million ounces of physical demand. But there's only 32 million ounces in registered inventory. You can't deliver 120 million when you only have 32 million. It's mathematically impossible. The exchange will be forced to default. They'll declare force majeure. They'll settle in cash at manipulated prices. And when that happens, trust in the paper market implodes. The COMEX price becomes meaningless because no one believes they can actually get metal at that price anymore. Crisis number 3, counterparty risk explosion. This is the silent killer, the one no one's talking about. But it's the reason Morgan Stanley's risk managers are losing sleep. The silver derivatives market, the over-the-counter swaps and forwards traded between banks outside of the exchange, is absolutely massive. Estimates put it somewhere between 5 and 10 billion ounces of notional exposure. Most of it is hedged, most of it is balanced, but not all of it. And the players who are short, the ones who've sold silver they don't actually have, they're starting to crack. Morgan Stanley can see this because they're active in the interbank lending market. They can see which banks are suddenly scrambling for more collateral, Which banks are tapping credit lines? Which banks are showing up desperate for overnight funding? And what they're seeing is multiple major players in the silver market facing serious liquidity stress. Not insolvency yet, but liquidity crunches. They need cash to cover margin calls on their short positions. And when one of those players fails to meet an obligation, when one defaults on a swap or can't deliver on a contract, the contagion spreads instantly. Because every bank has exposure to every other bank. One failure triggers a domino effect. Morgan Stanley doesn't want to be anywhere near the building when those dominoes start falling. So they're getting out now. Now here's where it gets truly chilling. These three crises, inventory collapse, delivery surge, counterparty meltdown, they're not separate. They feed into each other, they accelerate each other, and Morgan Stanley's models show that once this feedback loop kicks into gear, it goes exponential. It spirals out of control until something snaps. Let me walk you through the doom spiral. It starts with falling inventory. As registered silver drops, traders and investors start to get nervous. They think, maybe I should take delivery while I still can. So delivery requests spike, which drains even more inventory, which makes people even more nervous, which triggers even more delivery requests. That's feedback loop number one. Falling inventory creates fear. Fear accelerates the drain, but it compounds. As inventory falls and delivery requests explode, the shorts, the banks and funds that sold silver they don't own, they start to panic. They realize that they might actually be forced to deliver metal they don't have, so they scramble to buy physical silver to cover. But where do they buy it? From COMEX warehouses, which drains even more inventory. That's feedback loop number two. Short covering accelerates the collapse. And then there's the third loop, the killer. As the shorts try to cover, as they bid up physical silver, the premiums in the physical market go vertical. We're already seeing it. Physical silver in some markets is trading $15, $20, even $30 over the COMEX spot price. Normally, arbitrage would close that gap. Traders would buy on COMEX at the cheap paper price and sell in the physical market at the premium, but that arbitrage depends on being able to actually get delivery from COMEX. And if COMEX can't deliver because inventory is gone, the arbitrage breaks. The premium stays sky high, which tells everyone the paper price is fake, which makes even more people demand delivery, which drains even more inventory. Three feedback loops, all running at the same time, all accelerating each other, faster and faster until the whole thing implodes. Morgan Stanley's models show this spiral is already in motion. They can see it in the data. They can see it accelerating. And they know from decades of modeling complex systems that once you hit exponential acceleration, your window to exit is incredibly narrow. That window, according to their projections, slams shut at month end. That's not a guess. That's not them being conservative. That's their mathematical calculation of when system stress exceeds the breaking point. Month end isn't random. At the end of every month, banks have to mark their positions to market for regulatory reporting. They have to show their risk exposure, their capital ratios, their leverage. If they're holding positions that are massively underwater, that shows up on their books. It affects their capital. It affects their credit rating. It affects their ability to operate. Morgan Stanley does not want to be holding silver when month end hits because they know those positions are going to show catastrophic losses. Losses that trigger regulatory scrutiny. Losses that crater their quarterly earnings. They want out before the snapshot. They want their books showing zero silver exposure. So when the bomb goes off, they can say, we weren't there. We exited beforehand. So here's your action plan. If you're holding paper silver, futures, ETFs, unallocated accounts, you have until month end to convert to physical or exit completely. Do not wait. Do not hope it works out. Every day you hesitate, the window narrows. Paper silver is going to become increasingly worthless. COMEX might default. ETFs might freeze redemptions. Unallocated accounts might force settle in cash at rigged prices. If you're holding physical silver, bars, coins, metal in your possession, congratulations, you're positioned correctly. Now hold it. Do not let short-term volatility shake you out. Do not sell because the paper price dips. The paper price is becoming irrelevant. If you want to buy more physical, do it now. Yes, you'll pay premiums. Premiums right now are running $8 to $15 over spot, depending on the product. But that premium is nothing compared to what's coming after month end. Better to pay $15 over spot today than $50 over spot in 4 weeks. Watch the COMEX registered inventory every single day. If it drops below 25 million ounces, you're in the danger zone. That's the threshold where default becomes inevitable. At that point, you'll have hours, maybe days, to make final moves. Pay attention to what other banks do. Morgan Stanley won't be alone for long. Watch for news of other institutions exiting commodity positions. Other banks shutting down silver desks. Other advisors telling clients to de-risk. Each one is confirmation the exodus is accelerating. The next few weeks are going to be chaotic, volatile, stressful. If you're holding physical, you're going to watch the paper price swing wildly and you're going to feel tempted to panic. Don't. If you're trying to buy physical, you're going to face supply shortages, soaring premiums, long wait times. Get what you can, when you can. To the skeptics, read the memo again. They didn't say adjust. They didn't say reduce. They said exit. Close everything, all positions, all maturities. Hard deadline. That's not routine. That's evacuation. Why would Morgan Stanley voluntarily walk away from silver trading revenue? Why would they turn down new clients? Why would they risk looking panicked? There's only one answer. They see something so dangerous that staying in isn't worth any amount of profit. Maybe they're wrong. Maybe their models are too pessimistic. But are you willing to bet your wealth on Morgan Stanley being wrong? That one of the most sophisticated risk teams on Wall Street, managing trillions, surviving 2008 with access to data you'll never see, are you betting they're just paranoid? I'm not. When the biggest players start running for the exits, there's fire. I don't need to see the flames to know I should be heading for the door. The memo is real. The deadline is real. The countdown has started. You've got weeks, not months. Use them wisely.